For more, let's bring in Tom Michaud. He is the CEO of KBW, a Stifel company. He's that guy exactly. I'm going to start off with what Tim had posited, and that is regionals over the money centers now for the difference in performance. Would you go with that, given where we are?
We would. That is actually one of our calls for this year.
Tim.
We would agree with Tim.
Right again.
Historically, the regionals have traded at a premium to the bigger banks, but the bigger banks, frankly, have gotten better. So they used to trade, like I said, at a premium. Now they've been at a 20% discount to the bigger banks. And we believe that that gap's going to close. But that doesn't mean the bigger banks won't do well. We think the regional banks are going to catch up. You even already see it. S&P's up 1.5%-ish. The big banks are up 3 year to date. And the smaller banks, regional banks, are up 6. So that sort of movement is already underway this year.
And M&A in the space, Tom, you talked about, I think, last time you were here, but you're going to see it in spades in 26, which we are now just beginning. So speak to the tailwind that
Well,
creates.
I heard the discussion earlier. The way I would describe it is you're on the clock. You know, I think a lot of corporate America feels like they're on the clock, and so especially financials, because the stark difference in the regulatory approach from the prior administration, this one, is so wide that you feel like if you want to do something, you should do it right now. And also, you know, stocks are an all-time high-ish. We've got an economy that's going well. So there are a lot of good reasons to take action now.
How do you think about the exposure of particularly the money center banks to the AI boom when it comes to the debt that they're helping to underwrite, the money that they're lending directly? I mean, should we be concerned if we're worried about an AI bubble? What is the extrapolation back to these banks?
Well, look, I mean, first of all, one of the potential negatives is that the industry's over-earning on credit right now. We're thinking that charge-offs are around 25 basis points. I mean, that could be 35 or 40 basis points pretty quickly. So credit has been one of the really bullish parts of the story, but it could normalize, right? But the banks, so I'm sure along the way someone may hit a bump in the road. But the banks are still pretty cautious, I believe. I don't believe they've changed their risk metrics much. So private credit has been willing to step in more where there's more leverage involved. That doesn't mean that a bank might not make a mistake, but I think the industry has been tried to sharpen their pencil and stay pretty conservative.
So, Tom, that's fascinating. So, because much in the way after the financial crisis, it seemed like the credit issues were transferred from the private sector to the public sector. At least the balance sheets were cleaned up, given to the public sector to then deal with it. I think of money center banks as kind of like the public sector. What you're now saying is that there's a lot more hair in the private sector. Does that mean, and I don't hear you saying you see a major bubble or problem coming, but does it mean that there needs to be more regulation there at a time when there's less regulation everywhere else? I mean, is the private credit world getting a little bit over its skis?
I mean, I think there'll be winners and losers in both categories. I mean, there are some really fantastic non-bank players. So I think, like
we had one on this week.
You'll have winners and losers all around. But I think I heard you talk about re-rating for bank stocks earlier, right? I think we're in notwithstanding the 10% credit card cap, we'll put that aside. But when you look at the big stuff that's happening, we are in a generational moment of deregulation, which is two things. One is, since the global financial crisis, regulators use perimeter regulation. Banks can and can't do things. They also regulated banks by asset size. It's now switching to they're going to regulate the business model, and they're willing to take innovation into the system. I think that means that banks are going to level the playing field a little bit with the competitors, you said, not all the way. I think banks are going to be able to be on their front foot more. And so I think the playing field is going to level, which could allow these banks to continue to re-rate higher.
Is there any concern, though, about this deregulatory tailwind, given some of the proposals the administration has come out with recently highlighting affordability? Particularly, you mentioned the credit card rate cap,
yes.
for instance.
So there's something else.
There's a fine line here.
Just as somebody who's been doing this for a long time, I used to think that the political season got hot in a midterm year in July. Well, assume it's January this year and it's game on. I mean, the number of proposals you're hearing, whether it's defense companies not paying dividends, or it's the governor of New York saying insurance companies should reward profits back to their policyholders. You're going to see a lot of progressive proposals all around. And the question is, how much of it is the market going to believe? I think the primary reason why the bank stocks did poorly earlier in the week was, I would say it's two parts: the credit card cap, 10%. Maybe it was one part. The traders really had a lot of momentum into them before the earnings, and while the earnings were really good, maybe they weren't good enough. So, but it's the macro issues of the election season. So I think there's a chance for investors. You're going to see a lot more proposals. All I can say is that if it takes an act of Congress, it takes a long time to happen, and there'll be lots of chance to debate it. And a credit card cap, for example, is one of those things we believe.